How common is seller financing in the real estate finance world? Stay tuned. Well, welcome to this week's edition of Note School TV, where we go live every Wednesday at 11:05 Central Time with the latest in what's going on in the note and real estate world. And today we have a couple of amazing guests. And before we get to our guest, well, a couple of things I'd like for you to do for me. Number one, like what you see on Note School TV. Yep, just hit that like. Also, subscribe. If you have not previously subscribed to Note School TV, you want to go ahead and do that. And then finally, hit that bell notification. Yes, go in and hit that bell notification right now so that you will be reminded when we do go live every Wednesday at 11:05 Central. And if you guys would love to have more information or hear more information about Note School and what we do, just simply go to noteschool.com/TV. Again, noteschool.com/TV. And we would be happy to get with you, share in that comment section. Just send us an email or check us out by going to Note School TV or noteschool.com/TV. We'd love to hear from you guys. So with that, why don't we do what we do at this time every week, and let's go check out the news. So guys, here we are. March is officially the hottest month or hottest March on record. Now, that has nothing to do with temperature, right? It has to do strictly with home prices. Yes, home prices up 17% in March year over year from last spring. Guys, this is the heat of the spring buying season, right? So we've got inventory is a factor. We've got, interest rates, just checking out interest rates. And today they are officially 5.123%. So it is going to be, well, I know that March, again, 17% overall. When we look over here where we were in 2012 and we're looking here, well, it's pretty amazing. But I'll tell you, May, really some are saying as high as 22% next month. So stay tuned. A lot going on in the marketplace, and we'll keep you posted. So now it is my great privilege to bring on Note School's founder, Chief Visionary Officer, my friend, Mr. Eddie Speed.
Hello, Joe.
Well, good morning, sir. How are you?
So would you say if Martha and I put our house on the market this week, it might be a good time?
Eddie, it would be a darn good time. It may even be a damn good time to put it on the market for sure.
Well, it's funny you mention that because we put our house on the market and we are officially showing tomorrow. So Joe, I believe some of your propaganda.
You're buying what I'm throwing down, huh?
You know, it's an awesome house. Our kids are out of the house, so we're making a little bit of a change, and just the timing of it was incredible. And Martha will be glad to know that they're projecting that April is also projected to be a heck of a month. So it's funny. Like all these armchair quarterbacks are like, "No, you've waited too late. You should have done it like 6 weeks ago." Or whatever. So, I don't know. The best time to sell is when it's ready to sell and everybody's ready to buy.
Well, no truer words have been spoken, right?
So our guest today, I have a long history with. I literally got to know them in the late 80s and early 90s very well. And they have a heart for something, Joe, that you and I have a heart for, which is gathering statistical information to help paint a real picture. Sometimes our gut feel is just bad pizza.
Yeah, could be.
And they have put together an incredible amount of research and they have high competency to really filter through it and give us the right thing. So really, Joe, without any further ado, I want to welcome Fred and Tracy Rewey.
Hey.
Hey, guys.
Thanks.
I want to be known as good pizza. I'm just
yeah, I know. I was trying to decide what to have for lunch, and now I know it's not going to be pizza. So
oh, well, it does. The saying does resonate, though, right?
It does.
It does.
Hey guys, so I made some good pizza the other night on the Big Green Egg, and it is amazing.
That's
awesome.
awesome.
Okay.
That's awesome.
If I say so myself.
We're excited to be here because, we love these seller financing stats, and some of the things might surprise people based on what they know about the hot real estate market you guys were just talking about.
Yeah.
Well, this is really the subject at hand, because we're always trying to grip at, like, how big is our world? How many assets are we talking about? How much money are we talking about? We're in a niche. We've always been in a niche. I met you and Tracy in a niche market. You guys were working for the biggest institutional note buyer for seller financing in the country at the time. And you guys were on the executive team there. So we have a long history together of doing it. Joe too.
Yep.
We're just excited because I think that we're going to have some fun today, not only looking at what is history, but being able to look forward into what drives history in the future, right? What's going to trend the market and what that looks like. So you guys have a beautiful presentation. If we can pull that up, and we'll just go through it, Fred and Tracy.
So I'm going to jump off, and Eddie will do a commercial about halfway through, and we'll go from there. So you guys have fun.
All right. Thank you. It might be a little bit surprising for people to know that 27.3 billion with a B in seller finance notes were created last year. And that's actually up 15.9% dollar volume from the prior year, 2021 compared to 2020. So I don't think we were that surprised that the dollar volume went up, because everything's going up, right? All the prices are appreciating. But as the next slide will show, the count actually went up too.
Yeah, I think I was a little bit surprised by the dollar amount going up also, though, because remember, we tend to be a alternative to traditional financing. So the numbers are somewhere between 4 and 6%, depending on what's going on, of all real estate transactions end up being private note transactions. And so it's been really interesting going into COVID, and Eddie, you've been around as a long time as well. And, we've seen the cycles. We've seen when interest rates get higher. We've seen hot markets. We've seen cold markets. And we've seen, kind of the seller finance market put to the test. And certainly the last couple of years was an unusual test, both with COVID and then also really just lower rates than we've seen ever. So it would have been reasonable to assume that in the last 24 months, the notes being created would actually subside, because, the money was cheaper out there. Prices are going up. People, we kept hearing, particularly in the last year, of all these people buying houses with no appraisal, no inspection. We're closing in 3 days, or it's a cash offer. So it would have been reasonable to assume that the alternative to traditional financing, the numbers would go down, and they didn't. Actually, they increased. And I think that's the biggest surprising, not only by dollar amount, like Tracy said, which we could kind of extrapolate saying, hey, things are more expensive now, but also by count.
Yeah, Fred, I'm totally in agreement. I think we'll have some fun as we lay out some of these numbers, and then really say, where are we laying this out with the data going forward? Mm-hmm. Like what can that mean? So let's look at the slides here. As you guys said, man, an incredible amount of seller finance notes, and up in dollar volume 16%.
Mm-hmm. Yeah.
Pretty crazy.
Yeah, we'll break down where those dollar increases came in by category here in a minute.
Yeah, so I think the big thing is Fred, you brought up that not only did we increase in dollar volume, but we increased in number of transactions, just under 10%, 7% number there. And I think the three of us we probably are all thinking the same. It's because that we have a housing boom and a credit crunch.
Yes.
right?
Exactly.
Here's what we haven't weighed into the equation yet, and that is how inflation and the result of inflation of higher interest rates, which have really hockey sticked up since about November, quite honestly. October and November, and all of a sudden we start really realizing, the old saying is seller financing fills the void that conventional lending doesn't.
Yep.
Right. Okay, so we'll move forward here. Look at some more slides.
So it's just a visual of looking at, this is by count. We've got one by count and one by dollar volume. And if you go across there, you can see that we're about the same level by count that we were back in 2011. So It went up high after the 2008 to 2010. There was a big crunch in credit availability. It's harder to get a mortgage loan. And so seller financing went up, and then it got easier as things after the big crash sort of equalized in the real estate market. And we can see that we've kind of bobbed along there at those levels, but bobbed up a little bit in 2021.
So we'll show the mortgage credit availability chart as we progress, right? But the thing about it is this: the mortgage credit availability was worse in 2010 than it's been in 50 years, probably, right? Interest rates, I did a little research this morning. Interest rates were about equal where they are right now in 2009 versus today. And they've gone down. They've stayed down, averaging about 3.5%, 3.75%. It's bobbed up and down. It didn't go that for 10 straight years or even longer than that, 14 years, I guess. But the truth of the matter is that the mortgage, there's two things that really seem to drive how much seller financing: availability of credit, price of credit. Yeah. Right. And so it's interesting that we've seen it hockey stick up, and that's a pretty good jump in a year, really because of mortgage credit, availability of credit. By the way, there's some other stats. Did y'all know that 10% of GSE loans lost their market share last year? Wow. And they all went to non-QM loans. So Fannie Mae, Freddie Mac, GSE, Fannie Mae, Freddie Mac lost 10% of market share. And then it went straight to non-QM mortgages. Well, we would call seller financing a form of non-qualified mortgages.
Yeah, that's true. It's interesting. It's a correlating number a little bit there, huh? So this stat, what I really want to pull out this is, because it's a lot of numbers, but this is over the last 5 years broken down by residential, commercial, land. And then there's a little bit where, because of the county data poll, we don't get to know. But you can see that it went up to 27.3 billion. But when you add all 5 years together, and we look at what we believe is inventory out there available potentially to buy as note investors, doesn't mean they all want to sell, doesn't mean every note we'd want to buy. But we can see just in the last 5 years, there's 123 billion of available seller financing inventory. And that number always shocks people because it's a lot.
Yeah, and if you want to look at seller finance notes that get bought in the secondary market, I mean, the truth be told, it's probably $1 billion. Like $1 billion would be a big number, like literally for 5 years. And so it just shows you how much of the market that is not bought. People talk about, I'm very involved with all these real estate masterminds, the most competitive market anybody's ever seen. And everybody out in the world, we all know people that are house flippers, right? Right. We don't know many people that are note flippers. And yet this is the not competitive market.
Yeah. Yeah. So we don't have to drill down all of these stats. They'll be available if somebody wants to see them. But yeah, 123 billion. It's a big number. And that's happening right now out there in this hot real estate market where people think nobody's seller financing.
Tracy, is that a real number that it went from 2020 to 7.5 billion to 14 billion?
Yeah, so that is a real number. There's a little bit of anomaly in there because you can also see that a lot of counties where we get this data is from Advanced Seller Data Services, and I also questioned that as well. He was able to pull a lot more of property types. So you can see that unknown number from 2020 dropped a lot. So a portion of that turned out to be residential, but also a big portion of that was just an increase as well. And you've seen a lot of increase we'll see the average note amount in residential went up a lot. That's coming up, but it went up a lot, the average note amount. So you think about it only being on the small, low value properties. We're seeing seller financing moving into higher valued properties. And we're also seeing those low value properties have appreciated a lot. A lot of them have doubled in their numbers. So that will be a big contributor to that average going up.
Well, as you guys know, I'm very active in the land business.
Yeah.
And we would love to owner finance every piece of land that we can. And we have not been successful owner financing a lot of land in the last year or so because you can get a conventional mortgage on land at 3.5% interest. But now that rate is jumping up.
Mm-hmm.
And so you see that the amount of seller financing on land went down.
It did.
And we are anticipating a turn there for the very reasons of not lack of credit availability, but lack of affordability. Right.
That makes sense.
Yeah. So I like that seller finance dirt stuff. And I sure wish we could get back in that space. I'm thinking that we can.
Yeah. Good. I think you're right.
So this is basically by property type here. The first one, we've kind of gone over these numbers, but this breaks down the numbers as far as you can see where the dollars go. And like Tracy said, you go all the way down the unknown. We've been able to, successfully, and we get a lot from Advanced Seller Data Services, get stuff out of the unknown category into the other categories. And you can see it goes residential, commercial, land. And that's the logical order that it's kind of always been. I think Eddie's point on land being lower now is valid. I also think that when you look at land, and we have other spreadsheets in there, when you look at land versus the last couple of years, there's a pretty significant land grab just prior COVID from developers that were buying large lots of land to build houses, which you're now seeing these houses pop all over. So I think they were definitely in acquisition mode. So there's going to be less of that land out there as well as the financing aspect. But the lion's share of it goes to residential, which is the 14.6 billion, which is 53% of the volume, seller carry by property type.
Yeah, and that's by the dollar volume. And it's a little bit smaller by the count volume, but it's still the lion's share.
That's great.
And then,
well, guys, I'm going to do this. We're going to have a word from our sponsor, Note School, and we're going to talk about strategies in a class that can relate to how do you go find this product? It's out there. Clearly, you can see it. Like, how do you go do it and how you go build financial modeling around it? Let's hear from them.
Well, hello, everyone. It is Brian with the teaching team here at Note School, and I'm excited that I get to be the one to invite you to the upcoming Gold in Notes class. That's right. It is a one-day deeper dive class that we call Gold in Notes because of how valuable this time spent is. This is a full day that we really get to dig into the nitty-gritty, the whole world of creative financing, not just how to acquire more deals, how to get access to more capital, how to defer a lot of the taxes for us as well as for the sellers that we're talking to, and really learn how to create your own notes. And really, once you learn how to create your own notes, this is really where we spend an entire afternoon really pulling back the curtain on what the note business is, from wholesaling notes, buying and holding performing notes to really build your wealth. I'll even show you a strategy called partials, which is by far the best wealth building tool I've ever seen in the real estate space. And we're definitely going to spend some time talking about non-performing notes, which is by far the biggest opportunity in today's marketplace, solely because of the events that have happened over the past couple of years. This is when people are not paying their mortgages, and we're going to make a lot of big money from these bad debts, and we're going to help a lot of people get a second chance. It's an absolutely fantastic day. Come spend a day really dig in and discover a lot of this stuff so that you too can start building your wealth. It's a day meant to really be engaging. Bring your questions, bring your comments, bring your business problems, and we will see you there.
Hello, everybody. We are back. Fred and Tracy Rewey seller finance experts for a long time, and we are talking about an incredible amount of information that they have gathered and put together in this beautiful report that we place an incredible value on in our shop because it tells us the trend in the market. I think this is what really a lot of us are thinking, hey, this tells me the roadmap. So let's look at this, guys. Let's talk about, I love this because it shows me how much equity is in these transactions.
Yeah. So this is interesting. And we all would have kind of suspected this to some point. And we've had a lot of debates internally here about this number and the increase, because obviously values have gone up. But, when you're talking residential at, the average is 77% LTV, the residential from the average note being 180,737 to the next year going up to 269,201 is a substantial increase that, we talked about, some of the stuff we talked earlier about the other category moving into here. Well, that would work the same relative percentage across all. So that wouldn't equate, you can't put it all on the 49%. We can't look around and say, well, in the last year, all properties around us have gone up 49% either. So it's a significant bump.
I think, guys, it's the credit crunch.
Mm-hmm.
The average seller finance transaction has typically hovered around $100,000, in years past. And, that's pretty crazy when you look at markets like California or Florida, which that's way far than the average price of a home.
That's right.
Mm-hmm.
And so we generally thought of seller financing be a low price band thing. And Fred, at this point, the data right here says that we're not far from a medium price house.
Yeah.
Yeah. And everybody talks about, let's talk California, you start talking about, $800,000, $900 home. These aren't the traditional, when you start, they don't weigh the portfolio over that much, so this isn't like there's $10 billion homes that all of a sudden get thrown and really skew the numbers too much because they're not seller financed that way. They go a different route. So this is closer to a real number. And, I think those of us who've been around for a long time that remember that, hey, a 45, 65, 85,000, 125, $135,000, loan, home sale was good. The numbers are a lot bigger now.
They really are.
They're definitely different. And I tell you, I just can't say enough about how valuable this is to really look at. So let's talk about commercial.
Yeah, another one with strong equity, a 71% LTV means that somebody had 29%, almost 30% down on commercial, whereas they had 23% down on residential. So we can see the average commercial size is larger. That makes sense, 495,000 compared to last year. But so it was a little bit of an increase, 17% increase. But yeah, it's same with land. It had a big down payment too. So I think people have this idea that it's all zeroed down in seller financing, and that is not the case.
Yeah, that's pretty incredible. 30% down on land. Our typical land deal when we offer financing today is 25% down.
Yeah, I like
yeah,
that.
And the land going down, I think, to me, is indicative of that big acquisition of land over the last couple of years that developers are doing. I think this is just a little bit of a give back to, closer to the normal parameters of it.
Well, and country land is financeable with these farm credit banks now.
Sure.
That was never, it's always been available, but never to the degree it is now.
Mm-hmm.
When we write a contract for somebody to go to farm credit, we almost never see the deal go away. It closes.
Wow.
And we try to pre-qualify the buyer to make sure that we're not dealing with somebody that's terrible, but no, it's really been the case. But the affordability, land credit probably 5 years ago was 8% for a 20-year fixed rate mortgage. So it was 200 or 300 basis points above the normal.
Right.
Now it's been for the last 2 or 3 years, it's been as low as the normal. So obviously we see it with rates adjusting back up. Overall, I think the big picture here, guys, is that you guys are showing this is an equitable business.
Yeah.
Right? The average loan balance is way bigger than we thought. Commercial, $500,000, right? And commercial, the commercial days, I don't know how it looks down there, Fred and Tracy, in your neighborhood. I know y'all are going to be with us next week up here. I'm excited about that. Right around South Lake, where my office is, and every little office building has a for lease sign in the front window. I mean, almost 100%.
Wow.
And so, and they're not, and it's nice and it's high dollar, as you guys well know, but it's, I think that the use of seller financing for commercial is going to kick in high gear.
I would agree.
Okay.
All right.
So this is a breakdown that we have a spreadsheet that goes through all the states, but basically this is just a breakdown to see who the top states are. Sometimes there's a little bit of jockeying for position, but normally in the first top couple, not so much. Texas is still number one and has been for significantly amount of time. California is number two, Florida is number three, and so on. You can see some of the other ones there.
And this is based on count, so we didn't want to skew it by dollar volume, right? So Texas always comes in over 20%. So you got a lot of seller financing. I don't need to tell you that in Texas, but other states that might surprise people as well. And then it sort of trickles down from there.
I think California always surprises people.
Yeah.
It always surprises me, and we see it every single year. But I mean, we just think of them as not progressive in certain areas, like this, or needing the seller financing from that matter too.
So I think just a comment here. I've always said that most everything about real estate investing or real estate transactions is a copycat system. We tend to copy what other people do. Yeah. And seller financing became very prominent here in Texas, probably about the time I moved here in the 80s. And because of that, seller financing is a common way of doing business. Realtors are more comfortable with it. Real estate investors generally are very comfortable with it. It's a conversation that people have about it. And I think that can these numbers increase? And the answer is, will there be a lack of credit? And will there be an increased cost of credit? And if those variables become true, then you could see these other states really kick in, because we've seen them do it in the past, right, Tracy?
Yep, absolutely. The top three stay there, but those other ones often jockey around. So, yep.
Yeah.
I always find it interesting also that they do jockey around, but with the exception of New York, they're almost all in a row. They're coastal, they're south coastal, they're west and south. I mean, so that's that whole, as realtors get more familiar and the word spreads and stuff like that, because there's no reason, center of Texas is just as far as, center of, Nevada or something like that. And yet it still works.
Yeah.
That's a good point. That's a great observation. All right.
So this also surprises people sometimes. We like to divide this into mom and pop note holders, somebody who just has created one note in the last 12 months, and then somebody who's created 2 or more notes. We call them a more professional note seller. And so this is in the last 12 months. We're using the 2021 data. So 84% of these note creators only created 1 in 12 months. We'd consider them mom and pop. And 16% created 2 or more notes. And then we break that down further to see how many created 2 to 3 notes and how many created 4 notes or more.
Yeah. And so what's interesting about that is that it's relatively almost in half. It's 9% and 7%. But, so if you take 16% of the entire pie does 2 or more notes, half of those are in the 4 or more note category, roughly half. That's a lot of people out there, that's their business, creating notes.
Yeah, it's and once again, the question is with particularly rising rates, does that number change where people start using it more as a business model? There's anomalies of people that do it right now. I had Mitch Stephen on with us last week, and obviously Mitch has done 3,000 of these, but there's not thousands of Mitches in the world.
That's right.
Right. There were mega hundreds of Mitches in the world in the 1990s, as we all well know.
Yeah.
And so that really was because primarily of there wasn't such subprime lending. So the lack of subprime lending really drove the availability of, finding niches for the self-employed and that kind of thing. So I'll think it'll be interesting as seeing how we progress there.
Yeah.
So.
One more thing on that, when you do drill down farther, which is not something we did in this, because this is kind of an abbreviated one, you'll see that the multi-seller category has been about the same for quite some time. It's roughly, 14, 15, 16% or whatever. It's not like all of a sudden we've got this giant spike in that area.
people that do it tend to do it, and they find a way to do it.
Yeah.
And people that are sort of in and out. There's sort of people that enter out based on what the market conditions are. I think that inflation is going to have an interesting perspective on seller financing, for sure. So, all right.
Well, what's happening 2022? You say the exact same thing, Eddie. I mean, you were talking about it earlier. Interest rates are on the rise. That means the payment somebody's going to pay every month is going to go up. Means less people are going to qualify because they look at what they owe compared to what they make. It's going to be harder to get financed. It just is.
Yeah. Yeah. And, I started in the business totally by accident. I say that you guys started in the business intentionally. I started in the business just by accident, really. And, but I started in 1980, and I read a lot of stuff, as you guys do, about, what's going to happen in inflationary markets, and you need hard assets meaning something like real estate. And some real estate is going to do really well in inflationary times, and some real estate I think is not going to do as well. The theory is I'm just going to keep raising rents to match inflation. The question is, does the market let you raise those rents that high?
Mm-hmm.
Right. And so we tend to see a lot of creative financing, seller financing, particularly in other markets. And I think this is your last chart here, and that really tells the story, Tracy.
Yeah, and I'm going to let Tracy talk about this, but I want everybody to think about one thing going into this, because we've seen proof of concept in this industry decade over decade, and constantly we're reinforced, not surprised, but reinforced in how stable we think it is. But Eddie, you brought it up a little bit earlier, and I want Tracy to break down this chart, and I want everybody to understand this, is that we have a tendency to look at, hey, interest rates alone drive the market and stuff like that, as far as the creation of seller carryback notes. And that's not the case. It's truly, because, we would, if that was the case, then bottom line is when rates were 3%, over the last 18 months, we would have had no note creation. Yet we still grew in a market. It really comes down to what's the availability. If you didn't qualify for a loan at 8%, you still don't qualify for the loan at 3%. It's nothing's changed in the underwriting, with the exception of maybe your ratios got a little better because the money's cheaper. So, but this is a super important index when we're talking about what the availability is.
Yeah, so you also use this chart. So we both agree that this really shows the availability of credit. And we can see that it was easy to get a loan on a traditional home. And then when COVID hit, everybody tightened their underwriting. So they wanted more down payment, a better credit score. And as Fred mentioned, money was cheap then, and still the availability went down. So now when interest rates go up, the availability even goes down more. And so when you draw a line across to there, you can see that we are about availability somewhere between 2013, 2014. We've got the same availability. And it's expected that availability is going to go down as interest rates go up and the price of homes continues to increase. The median home price cannot afford, the median income cannot afford the median home price. So that means availability goes down. So as availability goes down, we project seller financing will go up because it's the non-traditional form. That's where people turn.
I don't think there's any doubt if you look at the growth and seller financing, and it kind of, you went up, till about 2014 and peaked at 2014 and started going back down.
Yeah.
And you can look at this chart and say, there was more credit available. Now here's what's interesting. The seller financing didn't spike immediately up in 2020, which logic says it should have. But let's say this, there were a lot less homes sold, right? Price went up, volume went down.
Yep.
And there were a lot less properties sold. So it doesn't mean that seller financing didn't have a pro rata share of the amount of increase. It's just overall, there were less mortgages created on new purchases. It was, the mortgage business was busy because of the refi market, not because of new purchase market. So that's great. I mean, that's really, that really paints a good picture. And Joe, I'm going to bring you back up. I'm going to show these good folks how to go get access to this information.
Yeah.
Yeah, we're happy to give people a PDF of this if they want to go to noteinvestor.com/stats, and then you can download that. And we include some extra things in there
there's extra
too.
information.
Yeah. Awesome. So we'll put that in the show notes as well. So, guys, the truth of the matter is we've got decades of watching this market. We've seen it go up. We've seen it be really hot. We've seen it go down. We've seen all of these different things. So, Fred, I'll start with you first. What does nothing like a little forecast so we can play it back later and see if you were right? Right.
That's right. Yeah. I'm usually right because I'll go back to the
What are we thinking for the next 2 years?
It's a great question. I mean, I think if in looking at the availability, I like to trade stocks, so I like graphs and everything else like that. So. Will the availability credit go up? Yes, it will eventually, but I think it's going to take a downturn first. If you go back and look at some of that graph or even expand that graph, you can see anytime it starts to tighten up as much as it has right now, it's nothing to nudge the market either way on the credit availability. And guess what? We have inflation. We've been selling homes really high at this point. To your point on commercial, a lot of the stuff being empty, I think it's going to drop down, which is going to force us to have these seller carryback opportunities. We're definitely in a lot of uncharted territory because of COVID and supply chains and stuff like that. And actually, I just wrote an article on inflation recently on that. And, now it becomes a self-fulfilling problem because prices have gone up. So now everybody's going to their boss going, I need a raise because prices have gone up. Okay, here's your raise, but now we got to charge more for our services, and now it goes up. So we're in a dangerous cycle right now that's very volatile. But I think, as I said earlier, this is just more proof of concept. If we could create more seller carryback notes in the last 2 years with interest rates as low as they are, with people that shouldn't have been moving around anyway, with real estate prices that shouldn't have gone up as crazy as they did, everything was working against us really at that point, and we still created more notes by volume and by dollar.
Yeah.
I feel pretty good about it. I really do.
Yeah.
And then, you look at categories like commercial and stuff like that there's going to be a lot of, people are going to have to come to the table with more cash to put into a commercial building, which is going to bring the LTVs down in there, which is going to turn some investor returns pretty high if you're going to buy into that category. So I'm very optimistic about it. I am.
Bob Repass in our office was at a significant securitization firm for a long time, and he's got friends that were at that firm and now doing other stuff, Wall Street stuff and whatever. And there is the word on the street is there is a significant shoe to yet drop on commercial.
Yeah.
Mm-hmm. And so I think you're right, Fred, that seller financing will be an impact. Tracy?
I'll tell you, I agree with everything said. And I'll tell you the one piece I'm just scratching my head, wondering how to predict. And that's the hot real estate market. Yeah. I mean, the prices just keep going up and up and up. And I think we're all like, are we on the edge of another 08? And the thing that has happened differently is the supply and the demand, right? We've got so many markets that have less than a 2-month supply. Some markets have less than 1 month supply. That demand keeps pushing those prices up, even though we're all scratching our head wondering who's affording these, who can afford these, and now interest rates are going up. So that's the one piece of all this I don't know. I'm with Fred, though. The real estate market, we love the seller finance market as a note investor. We like to buy those notes at a discount. We like to turn them into partials. So we like seeing that inventory go up, and we like markets where it continues to go up even more. So if we're good now, I think we'll just get better as time goes.
Yeah,
that's great. When y'all figure that out, exactly what's going to happen, I would appreciate a message. Huh? Guys, you got it. I don't know. We talk about it all the time in our
when you've got it's taking 29% of your income to pay your new house payment, and to get a QM loan, you're at a 23%, debt to income ratio. There's a disparity there, but it's still working, right?
Yeah. And, even psychologically as an investor, you go, look, this is the max dollar amount I want to put into a note. You say, hey, look, I don't want to go over, 120,000, 130,000, whatever, 50,000, whatever the number is how much you want to note. and the numbers go up so high that you're like, so now I got to buy into my average note has to be 240,000 or whatever. I mean, so, like I'm, it's a tough mental hurdle because we're worried if the shoe drops, we don't want to be upside down. That's the whole reason why we love this industry. There's a lot of adjustments right now psychologically.
And there's always crazy money out there too. So
that's true. That's true.
The last thing I would say is this, and we've discussed it. We've peppered this all through the conversation, so it's not like it's a new thought. But historically, seller financings the amount of seller financing is very driven by prevailing interest rates. Mm-hmm. And if we see a continual increase in interest, we are going to see. I don't know if the avalanche is the right word, but a lot of seller financing. So if rates, Fred and Tracy, possibly could rates go to 7 or 8%, over the next 18 months?
I don't think 18 months, but I think it definitely could get there.
They're talking 5 or 6 more raises.
Yeah. I mean, I think you can get 7. Yeah.
Well, they're talking about a half of 50 to 75 basis points the 15th of next month.
Yeah.
So if that's the case, we'll all keep watching. It'll be interesting, and we can go back and watch this. It's on YouTube now, so you can go back and watch.
That's right.
We'll get to figure out whether we were right or wrong. This has been a great conversation today. Fred and Tracy are doing a charity mastermind with us. Thank you guys for that so much. They're flying to Texas, and we have some people that are all the money goes to charity, and we're going to go have some fun up in the country, and we will continue this conversation up there, I'll bet you.
I bet we will.
I'm sure.
And how we can profit from it, right?
Around the campfire, that's right.
All right. Thanks, guys. Joe, you close us up, please.
I will. Thank you so much, Tracy, Fred. We appreciate you guys. Look forward to seeing you soon. So again, to find out more about what we do at Note School, simply go to noteschool.com/TV. We would love to see you guys in a one-day class here very soon. The Chinese philosopher said, may we live or may you live in interesting times. And as you can see, these are interesting times. So again, we appreciate you being here. Next week will be our monthly industry update. So more to come on what is going on in the news next week, our big show for the month. So guys, I'll say, as we say every week at this time, we'll see you on the other side. Have a great week.